Good afternoon. Thanks so much for joining us today for Julia Shanks' presentation on Business Accounting for Farmers, hosted by the Carrot Project. My name is Genevieve Goldleaf. I'm the Program Assistant for the Carrot Project. And before we get started, I'm going to tell you a little bit about the Carrot Project and our presenter, Julia. The Carrot Project is a nonprofit based in Boston, Massachusetts, that provides financing and business assistance so that farm and food enterprises thrive. We offer specific programs for loan and financial technical assistance to farm and forestry and fishery businesses, and to processing, distribution, and storage enterprises with any type of local agricultural product. We work with businesses at all stages, from pre-startup to maturity, including those who are having trouble obtaining financing elsewhere, such as startups and beginning farmers. That said, businesses that already have a working business plan are ideally suited to apply for loan or technical assistance with us. Our capital or operating loans range from $5,000 to $75,000 at 4.9927% interest. Applications are due the first business day of the month, so our next application deadlines are February 2nd and March 2nd. It typically takes about 8 weeks from the time a completed application is received to funds in hand, but you can start working with us earlier, so get in touch if you are interested for this coming season. The free technical assistance services that we offer include assistance preparing application materials, developing cash flow projections and enterprise budgets for new projects, reviewing business plans, evaluating financial options, and determining business profitability, growth, and direction. We are sometimes able to work with non-borrowers in our service areas to provide TA, so feel free to get in touch to find out if you're eligible for that. The regions that we serve include Maine, Vermont, Massachusetts, the Greater Berkshires, and the Hudson Valley. Outside of our technical assistance and loan programs, we also conduct research and collaborate on trainings. Some of our current work includes offering Train the Trainer sessions to increase the quality, of financial technical assistance available to farm and food enterprises, sharing our innovative financing models, and ongoing research to demonstrate the impact of financing and business assistance on small farm viability. If you would like to find out more about our programs, check out our website, which is www.thecarrotproject.org, or contact our Loan and Business Assistance Coordinator, Benneth Phelps, at bphelps, BPHELPS, at thecarrotproject.org. Okay, so all that said, it is my pleasure to introduce our presenter today, Julia Shanks. Julia is a Cambridge-based chef and entrepreneur who consults with food businesses and farms, helping them maximize profits and streamline operations through business planning, feasibility studies, and operational audits. Her clients include Life Alive, Cuisine en Locale, The Elephant Walk, the Massachusetts Department of Agricultural Resources, and City Growers. She lectures on sustainable food systems and restaurant accounting, sits on the advisory board of Future Chefs, and is the regional leader of Slow Money Boston. Julia received her professional training as a chef at the California Culinary Academy in San Francisco, her BA from Hampshire College, and an MBA magna cum laude from Babson College. We're very glad to have her on board today, so thank you, Julia. I will let you get started in just a minute, but I also just want to mention how we're going to structure the webinar today. Julia will pause for questions a few times during her presentation, and then we'll have 15 minutes for questions at the end. Because there are a lot of folks on the call today, we're going to ask you to type in your questions as you go along, and Julia will answer a few of those during the presentation and the rest afterwards. All right, thank you so much for joining us. Without further ado, I will turn the floor over to Julia, and we'll get started.
So today's agenda, just wanted to give you an understanding of why bookkeeping and accounting matters so much, the overall goals for this webinar and for your learning in general with basic accounting. Then we're going to go over the 3 most common financial statements, and then the concepts that you'll need to understand as you develop your own bookkeeping systems, and then we'll talk about how to actually apply all this information. So why bother? Why bother keeping records? Why bother accounting and bookkeeping? The first thing is that you know if your business is profitable. If you have a good income statement, you know if your revenue exceeds your expenses, you know where you're making money, where you're losing money, and how you can do better. And if you are doing bookkeeping, you're more likely to be able to avoid cash crises. But if you do get yourself in trouble with good bookkeeping, you can really help manage those crises better. You can figure out if you can afford to buy new equipment. You can figure out when you can afford to buy new equipment. And of course, filing your taxes and providing documentation to prospective lenders and investors like the Carrot Project. Jenny, can you put your phone on mute?
Oh, sorry about that.
It's okay. So the basic goals of bookkeeping and accounting. So first of all, it's really important just to get the basic concepts of accounting, because when you understand the basic concepts, then you can better develop the systems that are going to work effectively for you to track your finances. And once you start tracking your finances, you can measure your progress against benchmarks. For example, if you want your labor to be 33% of revenue, you can track that once you have everything in your system. And once you have everything tracked and measured, you can start to plan for growth because you know what your revenue is projected to be. You know what your expenses are going to be projected to be. Ultimately, though, the goal is to ensure that you are not only ecologically sustainable, but you're also financially sustainable. And of course, we're going to go over a lot of information in the next 40 minutes, so hopefully your head won't explode as we go over this content. So garbage in, garbage out. Basically, what you put into your bookkeeping and accounting systems is what you get out. And if you just do something haphazard, then at best you'll be able to file your taxes and have enough information there. But if you are systematic and thoughtful about how you set up your systems and how you input your data, you can actually get a lot of information out of your bookkeeping system. You can figure out if a farmer's market is profitable. You can decide which farmer's market is more profitable if you're selling at 3 or 4. So the primary principle in bookkeeping and accounting is to be consistent in how you enter your data and be consistent in entering your data regularly. Now, as you go out into the web and you look for templates and tools and different resources, people are going to suggest to you how you should set up your chart of accounts, how you should set up your accounting system, how you should name the accounts. What's important is that you're going to set things up in a way that makes sense for you so that you can be consistent. So, for example, if you buy soil amendments, every time you enter soil amendments, you want to put that into your accounting system the same way, and not, soil amendments one day and fertilizers another day or compost after that. So figuring out what system is going to enable you to be consistent in how you enter and track the data. So the first statement, probably most of you are most familiar with, is the income statement, and it summarizes operating revenues and expenses. And I want to emphasize the operating part of that statement. So it's the revenues and expenses that you have through the basic day-to-day operations of your business. If you're a vegetable farmer, then it's the revenue that you get from selling your vegetables and the expenses associated with running your business. If you're a livestock farmer, it could be the revenue you get from selling your meats and the expenses associated with running the business. Now, the expenses can be, the direct operating expenses, whether it's purchasing seed or feed, it's your labor. Occupancy is how much does it cost to rent the land, or if it costs you to own the land. G&A is general and administrative, so you need a website to put your storefront out there. For example, you pay bank fees and you have your cell phone, and etc., and repairs and maintenance. So these are the basic expenses that you have for running your business. And at the end of the day, you want your revenue to exceed your expenses, and that's giving you your profit, your operating income. What you don't see on here is grants or loans. And the reason why we keep those things separately is that it's really important to understand the basis of your operation to see if just at its core, can you run and operate a profitable business. I've seen farmers that will put grants as part of their revenue, and while maybe it makes sense for tax purposes to include it as revenue, it masks what the profitability of your business really is, because it shows you that you have a profit, but the profit came from a grant, not from selling your product. So can you make money selling your product? It's really important to know. Now, that being said, if you want to put your capital expenses or your grants on your income statement for your own clarity, then you want to put it below the operating income as other income and expenses. So then you can have the operating income plus or minus other income and expenses. And that, in addition to including grants, let's say you may be renting out part of your land to another farmer, so you may have other income that way. But it's important to keep those expenses and revenue separate. So cash is king, and it's really important to track your cash flow beyond your basic profit, because if you don't have cash in the bank, then you can't afford to buy the equipment you need or the seeds that you need, and generally pay your bills. A lot of times people think of just, cash flow from operations, and the cash inflow is the revenue, your outflow is operating expenses. And just because you have positive cash flow from operations doesn't necessarily mean that you have positive cash flow. If you have investments, if you're buying equipment or buying a new greenhouse or fencing, that's going to be a cash outflow that maybe doesn't show up on your income statement. And when you go to the bank and or to look at your checking account to see how much money you have, it's, oh, I have no money, but I had a positive operating profit. And then, of course, there's cash flow from financing. So if you get a loan or a grant or money from investors, that may not show up on your income statement, but it's still a cash flow. And as you repay the loans, it's going to be a cash outflow. So you need to recognize the distinction. I was actually working with a client a couple of years ago, and he didn't understand why he didn't have any money in the bank. When he looked at his income statement, he showed, $13,000 in profit. And then when he went to pay his vendors, there was no money, and he couldn't figure it out. And the reason why is that he forgot to account for the loan repayment that he had taken. And as it turns out, his business couldn't actually support the debt that he had taken on to start up his business. So it's really important to recognize that in addition to the cash flow from operations, you're going to have cash inflows and outflows from other aspects of your business. And number one, net income does not equal cash flow. A little levity. Finally, we're going to talk about the balance sheet. And the balance sheet is one of those things that bankers and lenders always want to see, and entrepreneurs just really don't see the value in it. And there's a lot that you can garner from it, but right now let's just cover the basics of the balance sheet. Now, the balance sheet is called the balance sheet for two reasons. One, it's an ending balance of what you have in all of your different accounts, and it's also a balance sheet because it's always in balance. The assets always equals the liabilities plus owner's equity. Another way of saying this is that it's a balance of what you have and how you got it. So you have your inventory, you have cash, you've got equipment, you've got your breeding stock, and how did you get that? Did you borrow money to get that? Did you purchase your seeds on account with your vendors, and that's an accounts payable? Did you use your credit cards or get loans to purchase all your equipment? Or do you own it? Did you invest some of your own money? Maybe you have an investor in your business, or you had net income. You used the profits from the business to purchase new inventory or to build the new greenhouse. So the balance sheet is really just what you have and how you got it. So here's the balance sheet equation, and then you turn it on its side, and that is the balance sheet. So I think we're going to take a little break to see if there are any questions about the first three, the basic financial statements. So Jenny, are there any questions?
We don't have any questions yet, but please, if there's anything that springs to mind, feel free to type them in, and we will take a look.
All right, sounds good. All right, well, moving on.
Moving on.
All right. So next we're going to talk about the basic concepts for creating systems. So when you do your own bookkeeping and accounting, QuickBooks is pretty much the gold standard for farmers. It's the most intuitive, it's the most common, and there's the most knowledge out there on how to use it. So I certainly recommend QuickBooks. The first concept is cash accounting versus accrual accounting. And what cash accounting means is that you record the revenue and expenses when you receive the cash. So, for example, if you sell a CSA subscription in February, you're going to record your revenue in February, as opposed to recording the revenue in, let's say, July, when you actually give your customers their CSA share. Similarly, your expenses are going to be recorded when you pay them. So if you go out and buy fertilizer or seeds, do you record the expense when you actually go out and purchase them, or do you record the expenses when you actually make the payment? So if you buy seeds from Johnny's on account and maybe you don't pay for them for 45 days, then you, under the cash accounting systems, you'll record the expense in 45 days when you actually give Johnny's the cash. So what that means is that there's no accounts payable and there are no accounts receivable. It means that there's no record of what your clients owe you as accounts receivable or what you owe your vendors as accounts payable. By contrast, accrual accounting means that you record all the revenue when you earn it and the expenses when you incur it. So, for example, with that CSA subscription, the revenue isn't recorded until July, and the seeds that you bought from Johnny's is going to be recorded in February. So why is this important? Well, it's really important because when you match your expenses and your revenues when they happen, it's easier to get an understanding of how your business is doing. So, for example, if you have labor in the fields harvesting tomatoes for the CSA subscription, you have that labor matched to the revenue, so you know how much it really costs to package those CSA subscriptions relative to the revenue. If the revenue is in February and the expenses are in May or August, then it's hard to really understand how your expenses work as a function of your revenue. And that's really where a lot of the insight will come about your business, is understanding the alignment between the revenue and expenses. I'm working with a client right now who uses cash accounting, and it is just so difficult to understand the nature of her business because I don't know, if labor is high or low, and if revenues are high in January, but it's really because they sold something in October. It's really hard to get insight about how the business is doing. Fixed and variable costs. Now, this is not so much important for setting up your QuickBooks, but more important to think about as you want to grow your business and understanding how to project what your expenses are. So your fixed costs are going to be expenses like rent that just don't change no matter how much business you do. If your rent is $100 a month or $100 an acre, it's going to stay the same whether you sell $5,000 worth of product or $2,000 worth of product. So as you think about growing your business and how your expenses are going to change, you'll want to know that the fixed expenses are going to be the same. By contrast, your variable expenses are going to fluctuate depending on how much revenue you have. So if you sell more tomatoes, that means that you had more seeds to purchase. And if you sell more pork, that means that you had to buy more feed for the animals. So the variable costs are going to increase as the revenue increases. And similarly, hopefully, it'll decrease as the revenue decreases. Now, it's important also to separate operating expenses from capital expenses. And this is important for bankers and lenders as they want to see your financials, but also in thinking about how your business is doing. So the operating expenses are going to be things that are, you can use up in a year. Black plastic that you buy for your fields. That if they get used once and then they're essentially done, or your hand tools, which are, $50 or $60, animal feed, things that are going to have a longer life. You're going to want to capitalize those expenses, and they're going to show up on your balance sheet as something that you have for a long time. They're actually going to be an asset as opposed to just an expense. And the reason why we'll do it this way is that you can then depreciate them. So you're going to assign a value for the long-term assets over the life, over their useful life. So what depreciation does is says, well, my greenhouse is going to last me 5 years, and I'm extracting value from my greenhouse a little bit at a time. So I'm going to assign that expense of that value each month to my business, as opposed to saying, oh, well, I bought the greenhouse for $3,000 in January, so now I have that expense in January. So by capitalizing expenses, you can show their value over a long period of time. So when you enter things in QuickBooks, you're going to want to put everything in their specific buckets. Everything has a place. You know, you think about the shoebox of receipts that you have, and you know, you have your receipts for gas, and you have your receipts for greenhouse expenses, and basically everything has its place. So you want to make sure that you put everything in its appropriate bucket and in its appropriate place. And this is especially important when you're using QuickBooks, because this is how it's able to really sort through the information that it has. So these are just some examples of the expenses and buckets, account categories that you can have in QuickBooks. So actually, I didn't put in any questions at this juncture, but we're about to go on to a new topic, so I'd love to stop and take questions if there are any. Okay, so can you tell us how the three statements are related? Again, so the income statement is basically focused just on the operations of the business, whereas the cash flow is going to tell you what's going on in the entirety of the business. So not just what's going on in the operations of the business, but also, you know, how you're financing things and what sort of equipment that you're purchasing. The balance sheet is more of a statement of time. So how, you know, what do you have at this point in time? So, you know, the income statement is what happened over a period of time, whereas the balance sheet is just, you know, right here, this snapshot in time, what do you have and how did you get it? So the balance sheet is actually going to keep track of, you know, your net profits over time as part of owner's equity. So the balance sheet links into the income statement by tracking your net income, and then your changes in assets and your changes in liabilities is going to be a function of your cash flow for the entirety of your business. All right, one more question. So is there any way to account for farm labor as a capital expense, like when you're building a greenhouse? Certainly. You know, if you want to put your labor as part of the greenhouse, and then you can capitalize the whole process of building your greenhouse, not just purchasing the stakes and the plastic and the door, but also you can put in the labor as a part of the greenhouse as well and depreciate that as well. Excellent, great questions, thank you. Okay, so now that we've got this large amount of information, let's talk about how you can use it. What do you know, you've taken all the time to, you know, keep good records and, you know, enter everything into QuickBooks. So now what can you do? Well, you can figure out if you can afford to make a new purchase. Are you charging the right price? Are your expenses in line? How much does it cost to enter a new market, and can you afford it? And of course, you know, you need to file your taxes. So the best way to think about all of these different things is to look at what your historical performance is. Once you've got a good record of at least 1 year, you can then, you know, use that information to move forward. But of course, as those stockbrokers always say in their disclaimers, performance data quoted represents past performance, and past performance does not guarantee future results. But it's the best thing we've got. You know, presumably your historical information is going to give you some sort of indication of what you're going to do in the future. So, you know, how much did you spend on seeds this year? How much did you spend on black plastic? And what were your bank fees? And how much did it cost you to drive to the farmer's market each week? So, you know, maybe it'll change next year, but you can look at the previous year and say, well, how did I do? And how do I think it will change accordingly? Why is it? Okay. So this is an example of somebody's financial statements, you know, organized by their revenue and all of their expenses. So you can look at the numbers and you can think about the numbers as a function of revenue. So how much did they spend on accounting relative to their revenue? Is it a fixed cost or is it a variable cost? Similarly, they can look at their fertilizer expenses, their labor expenses, how did things change? So they can use the information as an indication of what they think they'll do in the future. A little brain break, a lot of heavy content. So any questions right here? Okay. So a couple of questions about depreciation. Do you depreciate according to an IRS schedule? Yes, you do depreciate according to an IRS schedule, and certainly your accountant can guide you, and there are, links and guidelines on the IRS website about how you depreciate things. And why do you depreciate is another question. So there's a couple of reasons to depreciate. For taxes, there's not necessarily a tax benefit because you're spreading out the expense over time, which means the tax benefit is spread over time. So you don't really get that benefit. The real benefit is understanding how your business is profitable. That if you're getting value from your greenhouse for 5 years, by depreciating it, you're assigning a little bit of an expense throughout the 5 years by using that depreciation expense. So you can see how profitable is my business by using not just the bank fees and the labor and the seeds that I'm purchasing, but also what is the value of the greenhouse and how does that affect my profitability. Depreciating is also a really good way to think about saving for the future. So if you're using up a little bit of the value of the greenhouse over time, and let's say you depreciate $400 a month as the value of your greenhouse, you can start thinking about replacement cost. All right, well, in 5 years, I'm going to need to replace my greenhouse, so I better start saving that money today. And the depreciation expense can be a guide for how much money you're going to need to save to replace whatever it is you're depreciating at the time that it runs out. Oh, whoops. All right, so let's talk about crop profitability. The difficult thing about figuring out crop profitability is that there's a lot of measurements. We think about getting the crops into the ground, and we think about it by acres. We buy seeds. How many feet can we plant with a pound of seeds? How much fertilizers and amendments do we need? How many stakes do we need to buy? How much labor do we need to plant and weed over, an acre? And then after the crops are in the ground and we're ready to harvest, we start thinking by cases or by pound. How much does the box cost to package the tomatoes into? How much does it cost to harvest a pound or a case? How much does it cost to take each case to market? So it's important to, when you sort of think about the profitability of each of the crops, to align or to translate what is an acre into a pound or a case. So in the example of tomatoes, I was talking with a friend, a farmer friend in southern Maryland, and he gets about 34 cases of tomatoes a week from an acre, and I think he said his harvesting season was 10 weeks, but since I'm in New England, I cut it down to 8 weeks. So that gives us about 272 cases for the season and over 1 acre. So that's our conversion rate. 1 acre equals 272 cases, or 6,800 pounds. So let's start with getting the crops into the ground. So for example, let's say it costs you $20 to start your seeds. It takes you about 2 hours and you pay $10 an hour. You water, you transplant, you stake, you weed. So you're figuring out that based on, a couple hours, $10 an hour. You need to buy your potting soils and your trays. you buy your seeds, your black plastic, your amendments. So this is an example of what it might cost you to plant an acre of tomatoes. So total cost per acre is $390, and if we divide it by our, oops, wrong way. If we divide it by our 272 cases, then we know that it costs about $1.43 to get a case of tomatoes into the ground. Now let's talk about how to get it out of the ground. So it takes maybe 15 minutes per case. Then we've got to sort and pack the tomatoes, and that takes another 10 minutes. Those boxes cost 60 cents. So the total cost to get the case of the tomatoes out of the field and ready to go to market is $5.60. So the total cost to generate one case of tomatoes is $7.03. And I just want to reiterate that these numbers are somewhat educated, but mostly pixie dust. But just to give you the basic concept of how to calculate what a case of tomatoes costs to grow and to get ready to sell. So let's say you sell the case of tomatoes for $25. Oh, little levity. So now you need to sell the tomatoes. So you have to call your customers and get them to place their orders. You have to pack your truck. It takes you about 40 minutes to drive into town. It takes you a couple of gallons of gas. You know, maybe you've got a truck expense. So your total delivery cost is about $17. So it's going to cost you $17 to deliver, whether you deliver one case of tomatoes or whether you deliver 50 cases of tomatoes. So if you think about selling your tomatoes for $25 and your profit is $17.97 based on that $7.03 we had earlier, and your delivery cost is $17, then if you go to town with just one case of tomatoes, you're not really making any money. On the other hand, if you go to town with 10 cases of tomatoes, the delivery cost is still the same, but now you've got a substantial profit. So, you know, when you think about how you're going to distribute your product, you have your base cost of what it actually is to get the case of tomatoes, and then you have the delivery cost. So you want to make sure that it makes sense for you to go to market to sell those tomatoes. Now, the one caveat to all of this is that you have a $1.62 profit, let's say from 10 cases of tomatoes. Well, now you need to pay your rent, and now you need to pay your insurance, and you've got your bank fees. So it's really, you know, this is kind of your gross profit. Still needs to go towards the other expenses. So this, but it's, you know, I don't want you to get bogged down by, oh, geez, $162, that's not a lot of money. Presumably you're going to be growing a whole lot more than 10 cases of tomatoes over the course of your season, and so this will build up, and you'll have more money and you can afford it. So do we have other questions? Okay, so let's see. So what's the best way to transition from terrible record keeping to a good one like QuickBooks? Does it make sense to go through and retroactively put all your information in? Gosh, it would be great to put all your information in, but the challenge with that is that sometimes people get bogged down. And this is, you know, this is just the reality and honest answer that I would rather see you just start fresh and move forward and get a system in place that you can utilize. If you can go back and enter it in, that's great, but don't let that deter you from building good habits going forward. That being said, if you do want to start entering your data into QuickBooks retroactively, the point of entering it in retroactively is so that you can have that comparison data looking forward. So to enter it in retroactively, I would probably do it a little bit differently than how I would do it going forward. Just to get the data in there, I would probably group everything together by month, and I might just put in, I might get, for example, all my gas receipts and just put in one transaction for $300 for gas in January and $400 for seeds in February, rather than entering in every single receipt for everything that I purchased. I'll group it together by expense category, by revenue category, and by month, just to keep it a little bit more simple. So is there another option besides QuickBooks? Yeah, I know that there are a lot of other options out there besides QuickBooks. I'm not really familiar with them. I know that I think FarmEgo, and there's a couple of farm specifics. Peachtree, I've seen some farmers use, but Peachtree is kind of like using a sledgehammer when you just need a little mallet. It's a lot more powerful than what you really need. QuickBooks is cost effective. It costs about $200 to buy the software and download it onto your computer. It's robust. It has everything that you need. And it's really what everybody, or I shouldn't say everybody, but most people are using it. So it makes it easier if you need to get help from a consultant. The probability of finding somebody that can help you with QuickBooks is going to be better than if you're using a different system. So any other questions? Well, I want to thank you all very much. I'm happy to stick around for a few more minutes if there are more questions. And I have resources on my website. If you go to juliashanks.com, Tools for Entrepreneurs, there's templates for chart of accounts and cash flow projections. Okay, it looks like we actually do have a few more questions, so hold on, let me read them. So in QuickBooks, do you set your business expenses separately from your personal expenses? And I say absolutely, keep them separate. Even if you're a sole proprietor and you don't need to get a business checking account, quote unquote, I recommend that you have separate bank accounts for your business expense and for your personal expenses. Here in my own business and my own personal expenses, I actually keep 2 company files, one for my business and one for my personal expenses. It's easier to really see what's going on in each one. And QuickBooks certainly has the functionality where you can separate your business and your personal by using classes, but it's going to be a lot easier to see what's going on in your business if you just separate them out into separate companies and keep all your businesses separate. So I indicated that farmers might track labor hours and individual tasks performed on individual crops. Can you elaborate on how data is collected and entered into QuickBooks? Certainly. So QuickBooks has a couple of functions that you can use. There's customers and their classes. So you can track all your expenses. Let's say you buy $100 worth of seeds. You can then say, $50 of those seeds were for tomatoes, and $25 of those seeds were for cucumbers, and $25 of those seeds were for melons. So you can say that all of those expenses were in the seeds, and they'll show up as an expense under seeds, but then you can use classes to differentiate the expenses that are associated with the different crops. So by using classes, you can separate the different crops. So have a category for each one that you want to track. And similarly, if you pay your employees, you can say, all right, well, I paid you 5 hours to work in the tomato fields, and I paid you 3 hours to harvest watermelons. So you can then, divide up the checks and break them down by the crop that your employees worked on. You can also use the customers and job function to track what you're selling at each farmer's market. So when you come back from the farmer's market, you can say, oh, well, I sold $1,000 at the Newburyport farmer's market. So the Newburyport will be the customer, and then you can just have an income class for farmers markets in general. You can also then separate the expenses that are associated directly with that one particular farmer's market, whether it's special permitting that you need or the weekly stall fees. Then you can separate the expenses associated with that single market to that market. So then you can really start to see how profitable it is. So you can use the classes to separate out the crops, and you can use the customers to separate out the different markets that you go to. So can you speak to making a habit of entering your income and expenses monthly or when they happen? I tend to do entering in the data every couple of days. The thing is that if you can certainly do it once a month, but what happens is it becomes an onerous task if you wait to do it too long. If you do it every day, it's going to take 5 minutes every day, and it'll be easy. And when you come in from the fields and you're pouring yourself a cocktail and relaxing, you can spend 5 minutes entering it into QuickBooks and you're done. If you wait until the end of the month, then it becomes this big daunting task because you have a shoebox worth of receipts and invoices, and it becomes overwhelming. So you can certainly do it once a month. I recommend doing it when it happens because the probability of success and making a good habit of it is greater. Is it reasonable to do your own taxes as a farmer? Sure. There's no reason why you shouldn't do your own taxes, but it goes back to the cost-benefit analysis, and you need to decide for yourself, is it worth the time to do it yourself? If it takes you 5 hours to do it, maybe it makes more sense your time is better spent in the field doing what you do best, and paying an accountant to do your taxes for you. If you've been good about entering all your data into QuickBooks, then it's actually going to be really easy to print out an income statement, print out your balance sheet, and it's going to be a much easier process to do your taxes than if you aren't using a good bookkeeping system. If you do not want to pay for accounting software, what is the best way to go about creating a system in Excel? And are there templates available for this type of accounting? I don't know if there are templates available. I would say that while QuickBooks may seem expensive at $200, the time savings is going to be huge. That, if you set up a system in Excel, I can assure you that it's going to take you 20 hours additional or more to do a system in Excel rather than doing it in QuickBooks. And if you think about paying yourself $10 an hour, you're going to make up the time or make up the money in no time at all. If you do want to do it in Excel, I would suggest that you think about it similarly as you might in QuickBooks. So you would set up a column for the date, set up a column for the payee, for your expenses, a column for accounts, account name, so what's the income category, what is the expense category, a column for the customer or for the market that you're going to, and the class, so what crop is it for. So I'd still use the same system as QuickBooks, but entering in the data in columns. Do you have a sense of what a healthy net profit margin looks like for a farm that's been in business for less than 5 years? Um, that's a sticky question and really hard to answer. Farms can be profitable in the first year, not hugely so, and the profit margin can also depend on how much, what your volume of business is. So, you could make $5,000 off of $10,000 in revenue, or you can make $5,000 off of $100,000 in revenue. And there's so many factors that go into calculating the net profit margin. Uh, what does the profit need to cover? Have you paid yourself a salary, in which case the profit margin is gravy, or do you need that profit to then pay yourself? So part of thinking about what a good profit margin is figuring out what you need to survive. So if your target is that you need to make $30,000 a year, then $30,000 a year is what a good net profit is. If you need to make $100,000 a year, then that's what a good net profit is, and then you need to figure out how to make that happen. So for the person that has QuickBooks 2007, I see no reason to upgrade. It's fine. You can buy QuickBooks. It's a one-time expense. The software costs $200. One option is a recurring expense for QuickBooks is if you choose the online version. The online version can be anywhere from $15 to $45 a month. A lot of my clients like the online version because they can enter receipts on the go. If they're making a delivery, they can create invoices on the go. They don't have to wait until they get to the office to enter the expenses and receipts. So a lot of people like the online version. I don't like the online version because it is a recurring expense. I'd rather spend $200 once and have my QuickBooks for as long as I have my computer, and probably even longer. And I find that the reporting and the interface of the desktop version is a lot more friendly. Any more questions? Well, I want to thank you all very much. This has been terrific. And certainly feel free to be in touch by email or by telephone if you have more questions.
Great. Thank you so much, Julia. This has been a great discussion. We've had a couple of questions to whether this will be available later to rewatch or if the slides will be available. We will definitely be uploading a recording of this webinar to our website, and I'm hoping to get it up by Monday of next week. And Julia and I can discuss whether or not she's interested in having her slides up available separately as well. If anyone has any further questions, feel free to get in touch either with Julia if you want to contact her about her material specifically. You can get in touch with me if you are interested in hearing more about the Carrot Project generally. My email address is ggoldleaf, GOLDLEAF, @thecarrotproject.org. And you can contact our Loan and Outreach Assistance Coordinator if you're interested in more information about our loan and TA programs. And her email address again is bphelps, PHELPS, @thecarrotproject.org. Thank you so much to everyone who attended. We had a great crowd. And I'm hopeful that we'll be able to do another event like this soon. So thank you so much again. And thank you, Julia.
Thank you.